What's up, everybody? Welcome back to another episode of the Creativ Rise podcast. I am so glad you are here today. If you are new to the show, my name is Joey. I'm one of the two hosts of the show today. It's just me. This is a solo episode because I've got to tell you the story about how I had to pay a $48,000 surprise tax bill last week. And I want to talk about it. I want to talk about the very different outcomes that could have happened when I got that phone call and give you some encouragement and some actual tactical skills, give you a simple money management plan that's going to help you potentially avoid disaster, either that you're currently in or that you might experience one day, considering a tax bill or an expensive medical bill, a car bill, a house bill, whatever it's going to be. So here's the deal, guys. Controlling idea for today is that having a simple plan to manage your money is actually a lifesaver. This is something that I learned probably about 4 years ago-ish, and I've been implementing it ever since I learned it, and it has given me so much peace of mind about how I manage my money and about where my financials are at personally. And when I say personally, I mean Christy and I's financials personally, and where our business's financials are at personally. So it allows me to put my head down on the pillow at night and sleep well because I know what I am doing is actually managing my money safely and managing it well. So I want to talk to you today about the plan. But here's the problem. Before we get into the story of what happened, here's the problem that you are at risk of if you do not manage your money. If you do not manage your money well, your money will manage you, right? We all understand that. It's just the common truth. Most people do not know how to manage their money well. That's why so many people are stressed out about money. Most marriages break up over money. And most people that are in very, very difficult situations in life, whether they are living on the streets, whether they're this or that, it's probably because something happened with money that gave them two options, and their option A was if they had treated money well, they could have gone this direction. If they potentially did not, and a big bill put them out, it potentially could really cause some hard times in their life. So if you do not manage your money well, your money will manage you. That's the problem that I want to talk about today, and that I want to help you counterattack because I truly believe in that statement. So Here's the story. Now, just quickly before I get into the story, the last thing I want to say about this is money is a little bit like trust. We've all heard the statement, trust takes a long time to build and you can lose it in a second, right? Well, money is very similar. Building up money, building up wealth can take a long time to do, yet you can lose it in the snap of a finger, right? Again, with an unexpected medical bill, a tax bill, a car bill, house bill, whatever it's going to be. So here's a situation from my life last week. This is a very honest, very open look into what happened in my life last week. This is going to be a little bit of a funny podcast because maybe this is more personal than some of the other podcasts. But here's the reality. Last week, I got a call from my accountant 15 minutes before I was supposed to be leaving the house to go run a retreat for people flying in from all over North America. It was our Creativ Rise 4-day inner circle retreat, and I am literally in the shower, and I hear my phone ringing in the other room. And I was like, oh, don't worry about it. It's probably, somebody that does not need my attention right now. And then it rings again, and I hear Siri, as it's ringing, tell me who it is. And it says, blah, 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 blah. And I'm like, oh my gosh, that's my accountant. So he called me back to back twice. So I ran out of the shower, threw on a towel, and the part of the house that I was in didn't really have service. So I had to run into the backyard and stand up on this concrete little wall in order to actually have a phone call that wouldn't necessarily drop. So I'm standing on the back wall in the backyard, right on the edge of this golf course, and I'm completely just in a towel coming out of the shower. I'm soaking wet. And I call my accountant, and he says, hey. I said, hey. And he goes, hey, I wanted to call you because I didn't want you to get this news in an email. The second I heard him say that, I went, oh, shoot. What is he about to say, right? So I'm 15, 20 minutes before I'm supposed to be leaving. Christy's running around the house. She's got everything packed, everything ready. And she's like, we got to go. And I'm like, I know. It's my accountant. So he wanted to call me personally to break the news to me that I had a $48,000 increase in the tax bill that I was already expecting. And my $48,000 unsuspected surprise tax bill was due 7 days from the day I got the phone call. So you can probably think what I'm thinking. I'm sitting there going, oh my gosh, like I'm basically buck naked out in this backyard. I just got a towel on me. I'm soaking wet. I need to go. My brain is so focused on the retreat we're about to run. And now I am getting told by my accountant that I have a $48,000 tax bill that has to be paid in a week. What do I do? I'm sitting there and I was like, oh my goodness. So to be honest, I was super confused. I was scrambling to kind of get out of the door, obviously kick the retreat off. I was trying to get context on why I had to pay the tax bill. If your accountant ever calls you, I've got a great relationship with my accountant and I trust him a ton. However, if someone ever calls you and says, hey, you've got a near $50,000 tax bill to pay, your answer shouldn't be sweet, thank you. You should probably say, hey, give me some context on how this money accumulated and why I have to pay this tax bill. So I'm trying to hear him out. He's explaining things to me. He's wicked smart. I'm nowhere near as smart as he is. So I'm trying to play catch up with him and what's going on in his brain. And long story short, he broke it down to me. Here's the gist of it. I was not supposed to get my American green card. I applied back in 2020. I was not supposed to get my American green card until 2023 because the US government has been so backed up with immigration. So we were planning, my accountant and I were planning on me denouncing my Canadian tax residency and taking up permanent American tax residency because that's what happens when you get a green card. We were planning for that to happen late 2023. So the problem with this is that at the end of 2022, the government put out some type of new technology that basically auto-approved all the low-risk cases, and I was one of them. So praise God, I got my green card earlier than I thought. However, it comes with a few stipulations. I got my green card to live in the U.S. full-time on December 28th of 2022, which means that I officially denounced my Canadian tax residency the second I got that and took up American tax residency the second I got that. Now, I still own, I've lived in the States for 3 years, I still own a company in Canada. So our plan was over the next year and a bit to liquidate some special shares from that company in order to pay me out for basically a personal loan that I gave the company when I started that company a couple years ago. It's a little bit confusing if you've never, studied and figured out and understood how all the corporation stuff works when you build a company. But long story short, because I got the green card earlier than we thought, I still had a wad of cash stuck in the business that I was trying to liquidate in order for me to then move my tax residency to the States. So I'm still keeping the company in Canada, but there was a certain type of share that I had in the company that we were trying to liquidate before I was to get my green card. Because the green card came unexpectedly, I'll just give you the numbers. Liquidating those shares increased my personal income by $180,000 I was not expecting to have this year, hence why I got an extra tax bill of $48,000. So there's a bunch of reasons why this happened so last minute and so unexpectedly. Again, the government auto-approved my green card, and it was so out of the blue. We were not expecting it for another 7 to probably 10 months. So we didn't get the opportunity to liquidate those on the current plan we had set in order to do so. So my personal income jacked up because we had to liquidate some of those special shares. And now I have an income way higher than I wanted to have. And so my tax bill is way higher than I wanted to have. So I won't go into the rest of the story. But I had 2 possible outcomes that are so crucially important that I had to understand in that moment. And I'm so grateful when I look back at that moment. I will run you through these 2 possible outcomes. So imagine you get a phone call and your accountant saying you owe $48,000 to the government in 7 days. There's 2 ways I can go off that phone call. I could have hung up, and I could have been a person who does not manage my finances properly. And that $48,000 tax bill could have just been like non-existent in terms of my finances. I would not have the money to pay for it, okay? I would then be out of luck and now in debt to the government and paying interest on my debt to the government, my tax debt to the government. That is one outcome that I could have had. And that would have been a very, very scary outcome. That's not an outcome I would wish upon anybody. That's not a good thing. Not a great option. Now, the second option is I could be a person who manages my money well, manages it with intention. And I could have said, and this is what I ended up saying, this is very, very annoying. I was very, very annoyed when I got this phone call, but at least I have the money to actually pay it because I've been managing my money well. So, shocker, you can probably see where I'm going with this. I was number 2. I was, able to hang up the phone and go, this is extremely frustrating. I am so annoyed this came out of the blue. There was nothing my accountant could have done about it because of the way my green card came in so, sporadically. And he was doing everything he could to mitigate it and find ways to, lower it as much as possible. But it's still a frustrating conversation when you get a call saying you have a $48,000 tax bill you did not know you had, and it's due in 7 days, right? So, I got off the phone, and I was frustrated, but I was very, very encouraged because at the same time, I was living in frustration, but I also had the hope knowing that, hey, we've been managing our money well. And when I say we, I mean Christy and I, and then me managing it on the company. We've been managing our money well for years, which has put us in a situation where something like this, thank goodness, would not fully take us out. And for a lot of people, a $48,000 surprise tax bill might fully take them out, or a $48,000 medical bill might fully take you out. $48,000, house bill might fully take you out. So I want to share with you today, in the kind of last 5 to 7 minutes of this podcast, I want to share with you today the exact money management plan. It's very simple that I have used for 4+ years that has given me so much confidence when it comes to knowing that I am managing my money well and I am safe. If anything happens, we have got money to take care of business in many different ways, describe business in many different ways. So here's our system. If you do not have a plan to manage your money, I want you to copy ours. I want you to literally write down notes from the rest of this podcast, copy our plan. It is one of the best things you can do for yourself, for your family, and for your business so that you know you are taking care of your current self and your taxes and your future self by saving and putting money away. So it's a simple money management plan that involves 4 to 5 bank accounts. Now, these are separate from your one personal or a couple personal accounts. These are business-specific bank accounts, okay? So very, very specific that you go to the bank and you get business-specific bank accounts. If you do not already have that set up and you own a creative business, no matter how much money you're making, go and get business bank accounts, okay? So it's 4 to 5 business bank accounts. I'll explain if you are 4 or if you are 5. And it's a math equation to split up your money every single time you get paid. It's very simple. If this already sounds confusing and complicated, I promise you it's not. Here's how it works. You need 1 checking account and 3 to 4 savings accounts, depending on where you live, and I'm going to explain that in a second. So again, very simple. You need 1 checking account and 3 to 4 savings accounts. Now, the checking account's probably like $16.99 a month or $20 a month or $10 a month, and the savings account should be free. If they're not free, you need to go back to them and say, hey, I want a free one. They'll probably have a free one somewhere that has limited transactions, but you don't need a ton of transactions for these other accounts. So you have 1 paid account and a couple free accounts, okay? So here's the accounts you need to create. I'm going to rip through these quickly, and I'm going to give you the definition for each of them, how to use them, and then I'll talk to you about how you can create your percentages. So number 1, you need a main checking account, okay? So the first account you need is a main checking account. I call this a feeder account. All of your money from every single client always lands straight into this account. You never have money going into multiple accounts. All of your income goes into 1 feeder main checking account, okay? Very, very simple. Now, the second account you need is a tax account. So this is one of the free savings accounts, and you just got to rename it tax account, okay? So this is where you put aside money for taxes every single time you get paid. Keyword, every single time you get paid, you put money aside for taxes, okay? Now, the third account you need is another free savings account. It is called the Future Investments account, okay? So this is an account where you put aside money every time you get paid to pay for your financial future. When you are self-employed like myself, there is nobody taking care of me. I don't have a pension. Government's not going to pay for my retirement. I don't work at a company that's paying for my retirement. I don't have family money. I don't have some trust thing that's paying for my retirement. I am responsible for my own retirement. Therefore, every single time I get paid, I want to be pulling money from each paycheck and putting it towards a future investment account that I can use to push forward my financial future for my wife, for my kids, for my future family, for whatever, right? So that's very important. That's the third account you need. The fourth account you need, this might be the last account you need, but I'm going to add one more and I'm going to explain to you if it's applicable to you. But the fourth account you need is a rainy day account, okay? So this is a very simple account. Every time you get paid, you take a certain percentage of money and put it into that account until you hit about 6 to 12 months of living and operating expenses, and then you can stop filling that account. But this is a safety fund in case you fall on hard times, the business ever dries up, we go through a recession, whatever it's going to be. That's a very important account. Now, for most people, in the US, I'll just say in the US, that's where you can stop. You only need those 4 accounts. Now, there is a fifth account, depending on where you live, that is applicable to you. So for me in Canada, this is an applicable account. It is called a sales tax account, okay? So in Canada, despite if you're selling services or products, like goods or services, if I'm selling a physical product, I have to collect tax on it. If I'm selling a service like photography, I have to collect tax on it. Now, in the US, in certain states, specifically where we are in California, if you're not selling a tangible good, you're doing like a photo shoot for somebody, you don't have to collect tax. So you don't need a sales tax account if you are in a state or in a province or wherever you are or in a country where there is no sales tax. However, for a lot of people listening to the show, you might need a sales tax account. Now, every time you get paid, you got to make sure that you're pulling off the tax you collected from the sale and putting it directly into this account. Now, it is so important, guys, that you set up each and every single one of those accounts that is applicable to you. And once you have those accounts set up, that should take you 15 minutes online, or walk into the bank and take 15 minutes with a banker. It's not complicated. It's not expensive. And when you set that up, it's going to feel freaking incredible. I promise you. It's so cool. Okay, so now that you have those accounts, now that you know what those accounts are, it is crucial. This is step 2 of this simple money management plan. It is crucial you actually figure out what percentage you are going to allocate to each account every single time you get paid. So a percentage plan is how much money you will be putting into each and every account every single time you get paid. So here is how you calculate what you are pulling from your paycheck and putting into each one of those 4 to 5 accounts every single time you get paid. We are going to start with the tax account, okay? So the tax account, you've got to figure out every time I get paid. Let's say I get paid $1,000 for some job. I need to figure out how much of this money should I be putting aside for taxes and be putting it into the tax account, okay? So how you do that, very simply, number 1, you could just call your accountant, email your accountant. They will tell you how much federal tax you're going to have to pay and how much state or provincial tax you're going to have to pay based on whatever your estimated income for the year is going to be. An easier way, if you do not have an accountant or you don't want to bother them, I would still say do it, but you can always just Google it. Let's say you're like, I think I'm going to make 50 grand this year. Well, you can Google, if I make $50,000 in the state of California, in the country of the United States of America, what are my tax rates going to be? How much federal tax am I going to pay and how much state tax am I going to pay? All you do is add those together. So let's say you're paying, 15% federal tax, and you're paying like 7% state tax. And those are not the actual numbers. I'm just throwing out random numbers, but you've got to figure out what those numbers are. So you go, great, 15 plus 7 is 22%. Every single time you get paid, you now know you need to be taking 22% off the top. The first thing you do when you get paid, 22% of your paycheck comes off and you put it into the tax account. And you do not touch it because it's not your money. It is the government's money, okay? You're just holding on to it, waiting to give it to them. Now, it is only fair that if you're putting 22% or whatever your percentage is, let's say it's 15% or it's 30% or it's 7%, whatever your tax percentage is for both federal and state or provincial combined, it is only fair that if you're going to pay the government, the tax man, that amount of money every single time you get paid, you might as well pay your future the same amount, okay? So my rule of thumb is whatever you're paying the tax man, you should also be saving and putting aside, putting it into the future investments account. So you actually are building into your financial future. I don't want anyone who listens to this podcast to wake up in 15 years and go, wow, I have never saved money in order to pay for my own financial future in my retirement. Or I've never saved money to buy a house. I've never saved money to invest in a mastermind or some business coaching experience or whatever that's going to be. You've got to take off money every single time you get paid and pay yourself, okay? And you've all heard the term pay yourself first. Paying yourself first means before you just leave your money in your accounts all month and go through the whole month spending money, and then at the end of the month, you look at how much money you have left, pay yourself at the beginning of the month. So every time you get paid, again, the second you get paid, pay yourself to the future investments account. Therefore, you've actually got money set aside for your financial future, okay? So that's the second thing you do. First, you figure out your tax. Boom, put it in the tax account. Second thing is you match whatever you're paying yourself in taxes into the future investments account, or you up it. Like let's say you're only paying 12% in taxes and you want to go, I want to save 30% of my income and put it into the future investments account. I would highly encourage that, okay? So really, really easy. Now, a rainy day percentage is up to you. Christy and I use 7%. So every single time we get paid, we take 7% of that paycheck and we put it into the rainy day account. Now, here's the thing. Once that rainy day account, though, has got an estimated 6 to 8 months of living and business operating expenses saved up in that account, we stop paying that account because it's got enough. It's a good safety fund, okay? So very simple. You figure out what you're going to pay in your tax account. You figure out what you're going to pay to your future investments account. You figure out if you need to pay a flat rate 7% or something like that to your rainy day account until you've got enough money stashed up there for living and operating expenses for 6 to 8 months. And then you're done. Unless you need to also pay sales tax. If you have to pay sales tax to your government because of where you live and what you sell, every time you get paid, you got to calculate, you'll know this, whatever the number is of tax you had to collect on the sale, put that into the sales tax account. So in Canada, when I'm selling to a Canadian in certain regions, I have to collect 13% off everything I make, and I have to put that into the tax account. So very easy, very simple. I hope you're seeing how simple this plan can be. So I will give you Christy and I's numbers right now. You've got to come up with your own numbers, but here is the plan that Christy and I operate off. Now, disclaimer, these numbers might be very high for some of you, and you might be able to go, Joey, I could never do that the way you guys are doing it. And that's okay. You got to come up with your own plan. I have gradually bumped up these numbers as our income has grown over the last 10 years of working for myself. So this is a good spot to get to. This should be an advantageous place that you want to get to one day. Or maybe if you're already there and you can do it, awesome, do what we are doing. But if your numbers have to be lower than this in order to continue to pay for your living and everything, or pay for to run your business, that's totally fine. Work your way up as your income grows. So we do immediately, when I get paid, immediately I take 30% because that's my assumed tax, 30% of every dollar we make, and I put it into a tax account. Now, if it's only fair that if I'm paying the tax man 30% of every dollar that I make or Christy makes or we make together, I then pay 30% to our future investments fund because we are in charge of our financial future. And I do not for a second ever want to wake up and go, shoot, I've never been saving and investing for retirement. So 30% to the tax man, 30% to the future investments fund, and then we put 7% aside for the rainy day fund until we have 6 to 8 months of living and operating expenses saved up. And then depending on where the sale is coming from, I have to pay sales tax because it's a Canadian-based company. So we will take 13% or 8%, depending on which province the sale is coming from, and I have to put that aside. If it's coming from the sales coming from the U.S., we don't have to charge any sales tax, so nothing comes off that. So the sales tax account gets filled depending on where the sale is from. And yeah, so that's very easy. So 30% to the tax account, and then Christy and I put 30% away. So right off the bat, that basically means that Christy and I only live and operate our business off of 40% of every dollar that comes in. So we save 60% of our income for taxes and for future investments, basically. And then at the end of the year, if we've got a ton of write-offs, so our taxes are way less than we thought they were going to be, we roll over all the money that was in our tax account into our future investments account, and then we put that towards an investment that's going to build us a good financial future. So because of this strategy, guys, because I've been using this strategy for years, it's a very strategy to implement. Literally, the second I get paid, I go into my online banking, I just pull out a calculator, boom, 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 30% of that, 30% of that, throw it into this account, 7% into this account. It's so, so simple. And it feels so good knowing, okay, I am managing my money well in such a simple way. Because I use this simple money management strategy, the $48,000 tax bill that I got surprised with last week was devastating and annoying, but it was not going to take us out. The money was there. We've been prepping for this. We've been saving for stuff, and I was able to pay it and go, again, very annoyed, but at least I'm not getting smacked with some tax bill I don't have money to pay, and I'm going into debt with the government. So I urge you, you never know when an unexpected tax bill, an unexpected medical bill, a surprise car bill, or even a smart investment you want to make is going to come up. And you never want to have to say no to a smart investment. Never want to have to say no to, I can't join that mastermind, or say, no, I can't, hire that person, or say, no, I don't have the money to pay for my new car that I just crashed and I have to replace it. You never want to be in a position like that. So make sure you manage your money well. I hope you rip this system off. I hope you use the system. If you have any questions about it, DM us. We'd love to help you install this system into your life, into your business banking, because it is so, so helpful. So quick thing I should probably say too is with the remaining money that's left in the main account, that's the account that you use, the main checking account, after you've split up 30% here, or 15% to your tax, 15% to your future investments account, whatever it's going to be. The remaining money that is left in your main checking account is the money you use to operate your business and pay yourself out a wage. Okay, so that's where you send, $1,500 a month, $5,000 a month, $10,000 a month, whatever it's going to be, to your personal checking account, and that's what you then use to live off. So, guys, this has been a great podcast. I hope this has been so helpful for you. This is a really, really important topic. Super exciting little spoiler alert. Next week on the podcast, we are going to be releasing the mastermind dates for the fall mastermind, round 10 of the 6-week Creativ Rise Mastermind, which already has so much anticipation. The wait list is huge. It's bumping. People are joining it every day. You guys are DMing us about how excited you are for the next round of the mastermind. So if that is you, we've had such a fun time talking to you. If you're not yet on the next wait list for the next round of the Creativ Rise Mastermind, you should be. If you don't know what it is a 6-week mastermind that is so focused on giving you a growth opportunity in an environment where you're held accountable because you're surrounded by community. And Christy and I guide you through a ton of content, a ton of systems and frameworks that you can implement into your business, and you rapidly can see results in what you're doing. It's the best thing, the best stab at helping anyone who is a service-based creative learn how to make a foundation that's going to get them to 6 figures a year. So we love it. The 10th round of running it, this is going to push us almost up to 300 graduates at the end of this round. We are so excited. But if that sounds interesting to you, make sure you go to creativrise.com. You can click on the link in the description, and you'll be able to join the waitlist there. Other than that, guys, please, again, reach out if you have any questions about how to manage your money. This is such an important topic that we really want to make sure you grasp and just take full ownership over, so that if you one day get a $48,000 surprise tax bill like me, you have no problem paying it, and you do not have to go into debt in order to make sure the government gets paid, because no one likes that. So anyways, guys, from me to you, again, this is Joey signing off. Christy's going to be back on next week's episode, so stay tuned for that. And again, get excited because we're releasing what actual dates we're going to be running the fall mastermind in. You are not going to want to miss that. So if you love this episode, please share it with a friend who also needs to implement the system. Leave us a 5-star written review and rating. We really, really appreciate that on iTunes. On Apple Podcasts. That's how the show actually grows. Like, that's how the algorithm works, is based off reviews. So we'd so appreciate it if you leave us a review so we can have more people see the show and more people get to learn how to avoid future, huge tax bills themselves. So again, from me to you, we'll see you guys next week. Thanks.